Hello, this is John Summers. I'm a director at FMA, and I'm here today with FMA's founder and CEO, Hilda Polanco, for a brief webinar on the role of the nonprofit board in financial leadership. This is a perennially important topic in the nonprofit world, and we wanted to take some time to go over at least some of the high-level considerations that a board should have in mind when considering their responsibilities in governance and strategy and overall financial leadership. So thank you for joining us for this webinar, and Hilda, thank you for joining me today.
Thank you, John. It's a pleasure to be here, and I look forward to sharing some ideas and strategies with those of us attending today.
Great. Just to give some context and background, FMA's perspective on strategic financial management, which is the perspective from which the tools and resources on this website, strongnonprofits.org, were developed, is that it really consists of four key elements, and that's presented on the slide in front of us right now. Planning and monitoring, the cycle, the two arrows, really go hand in hand as the keys to good financial decision making. So we create plans about how we want to use our financial resources, and then we monitor those plans as we put them into action and understand what's happening, and then use that monitoring as further input and feedback into planning. Financial operations go to support planning and monitoring, so the people, the processes, the technology of the finance office help us be sure that we are making good plans, planning appropriately, and monitoring to understand the information that we're getting, and again, using that to reinforce and to provide feedback for our plans. And then finally, the topic that we're going to be spending our time today on is governance, this sort of overarching function that focuses on the board's role in providing oversight and leadership to the overall nonprofit organization. So my first question for Hilda, who's going to be answering my questions today, is really big picture. What is the board's role when it comes to governance over financial matters?
So, John, for the board, there are really two key areas of focus around governance for financial matters. And those two are, one, ensuring the regulatory compliance for the organization and assessing and managing the risk for the organization. The second area of focus, and where I feel strong direction and strategy is key, is ensuring that the financial health and the strategic direction of the organization is set at the board level with sufficient time and planning for maximum operations to be possible.
Great. So let's start in the compliance and risk management area. And I think this is probably the area that most boards are familiar with, or at least understand that a good part of their responsibility is about compliance and risk management. So can you help us break down just what that includes and what the board should be thinking about in that area?
Absolutely. We think of compliance and risk management as having really 5 different components. And the first one is, as a board member, you need to make sure that the federal, state, and other reporting requirements that are out there are being complied with. And so we want to make sure that on an annual basis, all required forms are taken care of. And in this era where so many nonprofits are raising money nationally, there are many requirements around registering in various states where dollars are being solicited. So at a board level, you would want to make sure you understand what states you're raising money in and whether you're fully in compliance. The second fiduciary responsibility around compliance is the hiring of the independent audit firm and overseeing that audit process. The board is responsible for the hiring of the independent audit firm. It is not the executive director, not the CFO, but the board itself. So we'll talk a little bit more about committees in a little bit, John, but there should be a section or a subset of the board finance and audit committee that handles this duty on an annual basis. Related to the audit, but more on an internal basis, is a third responsibility, which is acting as the stewards of internal control for the organization. As an organization grows and complexity is present in all of its operations, the board needs to make sure that the policies are in place to make sure that the assets are safeguarded. The board sets the policies and management actually implements the procedures that will ensure those policies are in place. As a fourth component of the compliance and risk management, it's around policies for long-term investments, and not every organization has long-term investments, but those that do, we want to make sure that the board is setting policies around risk and how the portfolio is being managed for a good balance of risk and return for the organization. And lastly is assessing and managing what I call operational risk for the organization as a whole.
Great. Just one thing to note for the viewers of this presentation. Anytime you see a blue hyperlink in the presentation, it represents a tool or resource that FMA has developed that can be helpful in this area. So all you need to do is download the presentation slides from this same page on Strong Nonprofits where you found the webinar, and then you can click on the links directly from those downloaded slides. So Hilda, one thing to follow up on here is this last point around operational risk. So when you say operational risk, it sounds like that might be something broader than just finance. What does managing operational risk entail?
Good question, John, and actually it is much broader. And what I've found through the years is that when a function is homeless, when there isn't really a committee of the board that's responsible, or at the management level, a position that's responsible, if no one owns it, it ends up with the finance team. There's really two areas of risk. And the first area I call the financial and fundraising risks. And they're anything from funder expectations, are we delivering on what we promised, to the risk on fundraising and fundraising events, and are events going to yield what we've planned for. And financially, just overall, there's risk in every budget that we developed. There's risk in every plan that we put together. So managing that risk at an ongoing basis is part of that financial oversight and balancing the actions we take based on the dollars that we think are coming in. But secondly, and separate from the financial risk, as part of this enterprise risk management, there's the people side. And on the people side, we see risk in a couple of ways. More largely, even beyond people, the number one risk for an organization is reputational risk. And reputational risk is about the organization as a whole. So you can see that enterprise risk management is not just about the finances, it's about the organization's operations as a whole. But again, someone needs to own the idea of thinking and assessing that risk. Secondly, in addition to the reputation and the financial, there's the risk around the human capital and whether they're volunteers or staffing. We find in speaking to insurance brokers that the number one cause of claims against officers and directors is in the area of what we'll call disgruntled employees. And so from a risk management perspective, as a board member, we want to make sure that the organization has the policies in place to address any human capital related risk.
Thank you. You mentioned that there are really two main areas for boards to focus on in thinking about their financial responsibilities. One is what we've been discussing about regulatory compliance and risk management. But then there's maybe a broader, or more proactive or inward-looking element, which is, you mentioned ensuring the financial health and setting the strategic direction for the organization. So can you break down, sort of like we did with compliance and risk management, some of the elements of that aspect of the board's responsibilities?
My pleasure. And this, I think, is the most strategic aspect of the role of the board. And that is, it is the board's responsibility to ensure the financial health of the organization. And we ensure the financial health by having a strong planning process. And in that planning process, I want to talk a little bit about the different key areas of the plan. So the first is really setting the long-term plans, the financial goals for the organization. Most organizations are very clear about their programmatic goals. How many clients will we serve? How many geographic locations will we have? I'm focusing here more on financial goals. And some of those goals might be understanding the full cost of programming and making sure that sufficient revenues are being raised. When we see organizations struggling with perhaps accumulated deficits or budgets that just can't seem to be balanced, in order to make sure that you can course correct, there needs to be an understanding of the full cost of programming. And at the board level, understanding what it costs to deliver our services on a program by program basis and making sure that we're raising dollars in the most strategic way to cover those programs is a really key priority. Secondly, the board really needs to plan for capital. And when I say capital, I mean both operating cash flow, meaning do we have the right amount of cash when we need it at the right time, and also investments in fixed assets. And what we mean by that is investments in things like computers and vehicles, and on a broader basis, buildings and improvements. That is a very critical component of managing the financial health of an organization. And from the board's perspective, the one way that you can at least begin to plan for capital replacements is through the concept of depreciation. Again, we have other resources on the site that help people think through what is depreciation and how can we fund it appropriately so that we can replace capital in the future. Lastly is this idea of establishing operating reserves and policies for their use. And we hear of organizations that are in this awful place of having very low unrestricted reserves and the limitations that brings. You as a board want to make sure that you're doing what you can in planning the financials for the year, so that there's a way to improve those operating reserves, which will give you risk capital, they'll give you internal credit lines, and they'll really allow the organization to manage its business without a sense of crisis. So those are the long-term financial goals and plans around operations, around capital, and again, around these reserves. The second aspect of establishing financial health is having the mechanisms necessary to have plans that you believe are going to get you to be able to deliver on these financial goals. So we want to make sure we have systems for budgeting, systems for monitoring performance and what kind of tools the board should be looking at. Scenario planning is something that's really critical at the board and management level. What people often refer to this as Plan A or Plan B. And then lastly, this idea of forecasting. Forecasting is really this idea that, yes, we should be looking at our budget to actual and understanding the variance as to why didn't our results end up the way we thought. But most importantly, life doesn't always happen the way we think it's going to happen. And in recognizing that life does bring us some unexpected events, forecasting allows us to focus on the future. And so from a board perspective, in addition to seeing how we're doing against budget, I would encourage that the organization develop systems for forecasting what the rest of the year will look like. And that keeps the conversation focused on the future instead of on the past.
So let's talk a little bit more about operating reserves, which I know is one of your favorite topics.
It is.
As well as being something that a lot of boards would like to strategize about. So what's the best way for boards to start thinking about reserves?
So reserves are equivalent to this concept on the audited financial statements called unrestricted net assets. And those are those assets that have no strings attached with any donor requirements or any endowment requirements. They are completely available. But when you're thinking of reserves, there's a finer point to the reserves, and that is that unrestricted net assets include all of your buildings and equipment. And while that's an asset that helps us in our daily operations, it's not a liquid asset. So when we think of reserves, we want to think of this concept that you and I, John, have sort of created here at FMA, and it's this concept called LUNA. LUNA stands for Liquid Unrestricted Net Assets. So as you're thinking of operating reserves that you would like to create for the organization, you want to think about LUNA and accruing resources that are really convertible into cash at any point. You don't want to count your fixed assets there. These funds are available for supplying working capital, for helping unexpected downturns in the economy, risk capital, pursuing new opportunities. And so we have several resources on the site and articles around how you calculate LUNA. But the key to it is that it's the liquid portion of those unrestricted net assets. The benchmark that we see that funders and lenders often refer to is this goal of 3 to 6 months, but that doesn't necessarily mean that 3 to 6 months of operating expenses is the right answer for everyone. It is one of those situations where it depends on the risks involved in your operation. So I encourage, if there's one, what we call key performance indicator, one KPI for the board to manage on a year-to-year basis, it's this growth of Luna or depleting of Luna. Because if you deplete Luna, you're weakening your ability to manage in the future.
So let's talk now that we have some good background on what the board's responsibilities look like and what they should be thinking about. Let's talk a little bit now about actually putting this into practice. So what are some of the best practices on how boards should actually carry out these responsibilities on a day-to-day or a month-to-month or a quarter-to-quarter basis?
Because the board is a very large group of individuals, there is this concept, not only in finance but in development and program, that there should be a committee structure. And within the board, there would be, in the case of financial stewardship, either 2 committees or one combined committee that would cover both audit and finance. And so the audit committee, if it exists separately or its responsibilities within this broader committee would be to, 1, hire the audit firm, as I mentioned earlier, and oversee the audit process, and 2, to be that steward of the systems of internal control. If we were adding risk management specifically to one of these 2 committees, if they were separate, I would say risk management would be part of the audit committee, because the audit committee is thinking about our systems, our controls, and we would add risk to that aspect. Finance committee, on the other hand, is focusing on those strategic plans, managing the financial health of the organization, monitoring those results, working with leadership at the executive director and CFO level. And really, the finance committee usually is headed by the treasurer, not always, but usually. And so we've got this either combined audit and finance committee or 2 separate committees. And just a caveat, there are some states, such as New York and California, that require separate audit committees based on certain thresholds. So you should check in your state whether there's a requirement to have a separate audit committee, but otherwise a combined committee is an accepted best practice. And again, the website has some tools to help you assess how you're doing in managing that committee structure.
Great. So finally, as one last point here, I want to talk a little bit about how management should be keeping the board informed about the organization's financial health. So I hope that we have some management people who are watching this webinar and some board people as well. So for both of those perspectives, for the management teams, what should you be providing board members, and for the board members, what should you be asking for or expecting from your management team? So what are some best practices around financial reporting to the board and even to other organizational stakeholders?
Well, that is, in fact, where it all comes together. If we can think of the stakeholders in 3 groups, the first group would be the program staff, the leaders in running the programs in the organization. The second group we could call the executive director or senior leadership in larger organizations. And then the third group of stakeholders would be the board. And these are all internal stakeholders that have a role in planning and managing the financial health of the organization. So just from a who gets what perspective, if we could just focus, John, on the program manager side, we believe that program managers should be seeing their budgets reports on a budget to actual basis, not only for the program grants, which I think is where most program managers are focused, am I meeting my grant requirements, but also for the program as a whole. So the individual that manages a program that often has multiple contracts funding it is really looking at the big picture for the program. And so they're getting those reports on a timely basis and on a consistent basis, hopefully in a format that they feel comfortable and they can understand and work with. The executive director, and we're talking monthly here as I'm going through these reports, is receiving, in addition to what the organization's program managers are receiving, the executive director is receiving the budget to actual, revenue and expenses for each program, but also for the organization as a whole. So how are we doing against this plan? The executive director should also be receiving a balance sheet. This is the statement of financial position, and supporting schedules usually are around receivables, how old are those receivables, payables, how old are those payables, basically what is the strength of our balance sheet, and there we would be keeping an eye on Luna, which is a component of net assets on the balance sheet. In addition to the budget to actual and the balance sheet, the executive director should be receiving cash flow projections. And one of the great tools on Strong Nonprofits is a cash flow template that helps organizations really have what I call the navigation tool for the executive director. When the ED gets that phone call where something significant is changing on a cash flow basis, this reporting is really keeping everyone informed and able to take action as expeditiously as possible. I mentioned earlier, John, the value of projections. And so in this package that the executive director receives, there should also be a year-end projection. And I'm not saying this in the very first month of the year, but certainly beyond 5 or 6 months of operations. It's really not only about why didn't we meet budget or why did we exceed budget, but how do we think we're going to end the year? And that focus on the future would be in these year-end projections that would be included in the report. And I encourage program managers to be involved in building those projections so that we build a sense of ownership over the future and what will be happening. So those are our internal management reports. So when we think of the third stakeholder, the board of directors, I'm going to kind of go through that package. You can see it's a building block. So the board is receiving, on a more summary level, what the program managers received in terms of budgets to actual. They're receiving the balance sheet, the cash flow projections, the year-end projections, so we're all on the same page. But you'll see 2 new items on this list, and one is something called a performance dashboard. And we have found that at the board level, you really want to stay at a certain level of navigation. So the 30,000 feet, maybe the 1,000 feet view. The performance dashboards allow boards to see, usually in a pictorial format, how are we doing against what we originally called key performance indicators. What's important from a growth or a balance sheet strength perspective for the board to be managing and focusing on. One of the most important components of this package is what I call a management narrative. And as a board member myself, when I receive the board package and I look at the financial part, my first go-to moment is the management narrative that the CEO has prepared that really focuses the review of this whole package. What are the risk areas? As a board member, what does management want us to focus on, and where does management need us to strategize? So the management narrative is in words, and it should probably be no longer than 1.5 to 2 pages max, and it really focuses the conversation that's supported by everything else. So I encourage leadership, CEOs, CFOs, to work on a narrative that works for the board and works for them. I would say one last thought, John, on this is that the board of directors needs time to review this information, so we want to get this to them maybe a week before the meeting. And I've been using the term board through all of this. I'm really focusing on beginning with the finance committee. The finance committee receives this information, discusses it with management, and then at the full board, it's really the role of the head of the finance committee, which often is the treasurer, to present these financials to the rest of the board. And so even if there is a CFO and the CFO is available for questions, I do encourage treasurers to take it as their responsibility to present the financials to the rest of the board. And just as a reminder, the finance committee members are maybe the champions of the financial conversation, but in no way are the rest of the board members not part of the financial responsibilities.
Great. Well, that's a lot of great information. I hope that the people who have watched the webinar got a lot of useful content out of this. Again, I just want to remind everyone that on strongnonprofits.org there are a lot of resources that we've, again, linked to. Just download the presentation document itself, the slides, and you can go directly to those links from the presentation. And also feel free to explore all of the resources available on the site. I want to thank you, Hilda, for sharing your knowledge and experience with us today.
Thank you, John. And thanks to everyone who takes the time to listen to this webinar. We encourage you to, after you've heard it, share it with others. Our goal through these presentations is to strengthen the sector, one board member at a time. Thank you.
And thanks to all of you for joining us.